Hey, folks, welcome to Exchange Traded Fridays, your weekly look behind the scenes of everything ETF. I'm Jeff Benjamin, Wealth Management Editor here at ETF.com, and I'm joined this week by an excited crew to talk about a lot of stuff. We've got Ron Day, contributing editor. We got Samit Roy, senior ETF analyst, and we're going to introduce our brand new managing editor, Paul Curcio, at the kind of the end of the show here. But I want to kick it off here with some talk about single stock ETFs. It's a hot button issue. I know Ron's very excited about single stock ETFs because he's really focused on the flows, the volume of these things. It's over the top, but my perspective is it makes sense that they're over the top because they're trading vehicles and they really shouldn't be held for more than a day. But I think Ron bought a few of these when they were first issued and still holds them. That's why he's so wealthy, right, Ron?
Yes, you can hear my gold jewelry shaking right now, Jeff. I mean, what I just was looking at the volume charts that were and the top like six or seven of these just in volume for yesterday, they were all leveraged ETFs. So, it wasn't even like the amount of money. It wasn't even like whether they were the gainers or the losers. This was most active ETFs, which these things did not register like 2 years ago, even like a year ago. They just would. This has just been a floodgates wide open, and to me, it seems like the story of the year where, just strictly looking at like a chart where these just did not appear, I don't know, 18 months ago. Now they own the top of the active ETFs being traded. I mean, the floodgates are wide open, and one thing we were discussing earlier was just that somebody has to be making a sliver of a penny on each one of these trades or whatever. There is. It's not the issuers. I'm not too sure. I don't know how the money kind of gets, starts flowing around the system. But there is clearly this is really assisting somebody with their, with the fees and their trading revenue.
Well,
So,
yeah, it's assisting people that want to make big bets and are aggressive. I mean, I think this is kind of an extension of the crypto bros, people that are aggressive and hungry. And I mean, and it's also, there's a lot of financial advisors that are using these vehicles for trading, but they're short-term vehicles. These things reset daily. There is a suite or two of them out there that reset weekly and monthly, but for the most part, these things are designed to take a single day bet up or down on a single security. And that's the novelty of them. They've been around less than 2 years. That's why you're seeing the volume spike. And it makes it a lot easier to lever up something or bet against something which would be a short sale. And that's what it is. I don't think they're going away, but the specific ETFs I think will come and go. But the strategy is there forever.
Yeah,
do
I,
you
I
think that they're going?
100% agree
Go
with
ahead.
that. And
I
Ron,
mean,
you hit the nail on the head. I mean, you saying they're actively traded, that's an understatement. Even outside of ETFs, I was looking one day last week when MicroStrategy was going crazy, and the two MicroStrategy ETFs, MSTU and MSTX, they were on the most active list for not just ETFs, but securities in general. They were trading as much as some of the biggest stocks in the United States. It was just insane. And I mean, I've been shocked at just how much demand there's been for these things. But I guess to some people, you see all the enthusiasm about, Dogecoin, GameStop. That should have been kind of the sign for us that, retail investors, they like these kind of like extremely volatile type of securities. And there's a lot of appetite even for, gambling in the stock market, things like that. The Economist had a cover story the other day talking about how sports betting and single day options have been taking off. And I think this is kind of an extension of that, right? People want to make quick money, and these are a way to make quick money in the stock market.
well, there's always, people worried about the next, either a crash or a collapse, or, people get too enthusiastic about a particular investment or whatever. And I don't know if this is something that is I mean, I guess it's a high risk if you hold on to them, right, Jeff? And I don't know if there's again derivatives or synthetic versions or anything kind of crazy. I wouldn't you can't put anything past Wall Street. Um, but definitely, again, as my point was, these were not even on the end of the day most active lists, whatever, even at the probably beginning of 2024, and now
Yeah.
they're just crowding at the top. It just seemed like I don't know if there's caution or anything that it could kind of snowball into something crazy.
Yeah. Yeah. For now, it's been great. I wrote a story earlier this week about how TSLL, which is the 2X Tesla ETF, hit a all-time high for the first time since it launched, essentially. And that's because if you've been paying attention, shares of Tesla have been absolutely skyrocketing. Those shares topped $400, $420, all-time high. First time Tesla has made an all-time high since 2021. And that's really benefiting the people in TSLL. In fact, the ETF now has $5 billion in assets under management. And I think it's up 6x from the low it put in just earlier this year. Incredible gains. But even after that, TSLL is actually not the largest single stock ETF. It's just behind the NVDL, which is the 2X NVIDIA ETF. That has just under $6 billion in assets under management. So you take TSLL, NVDL, and the two micro strategy ETFs, those are by far the largest single stock ETFs that we have on the market today. And like Jeff said, these are going to come in and out of favor depending on what stock is hot at the moment. Right now, it's those three stocks. I'm sure a year from now, 2 years from now, it's going to be a different stock.
Yeah. And again, I mean, they're piling in these assets, even though they're supposed to be held for a day or two. It does seem that there are investors who are holding them for longer terms.
Absolutely. Yeah. I mean, we say they're designed for short term. I mean, short term to everyone is different, right? And as long as these stocks are going up, I think there's going to be people holding on to them for weeks, even months. So, you
Fast
could,
money. It
yeah,
is fast
exactly,
money.
exactly. Buyer beware, but they're working right now.
It's crazy, and we'll see. I guess maybe this time next year we might just have a completely different story. I don't know if there will, but it seems like maybe in this kind, like when the markets are really grinding higher, these things will be popular.
Yeah, and I mentioned, NVIDIA and Tesla. Those are, of course, two of the Mag 7. I want to talk about the Mag 7 because I wrote a story about this group earlier this week, and this seems to me like obviously we know this is the go-to moniker for the most dominant stocks in the stock market. We used to talk about FANG all the time. Now it's Mag 7. But I analyzed essentially what has happened with Mag 7 this year. And believe it or not, they are up something like 67% year to date if you measure them based on the Mag 7 ETF, ticker symbol there, MAGS. Absolutely incredible returns. And in my story, I wrote every single Mag 7 member other than Microsoft is up more than the triple Qs and up more than SPY. You look at, Apple, it's up 30%. You look at Alphabet, 38%, Meta, 80%. And of course, NVIDIA, the absolute powerhouse, is up 180% this year. And all of those are fueling these huge gains in the Mag 7. And interestingly, I looked at the numbers and we all know the Mag 7 are important for, ETFs like MAGS, but they're extremely important for broad stock market ETFs as well, right? They represent 1/3 of the S&P 500 and any ETFs tied to the S&P 500 and 45% of QQQ. But even more than that, they represent a disproportionate share of the gains for those ETFs this year. For instance, the Mag 7 accounts for half of the S&P 500's 29% return this year. And it represents 3/4 of the NASDAQ 100's 29% return this year, even though they only represent 45% of the index in terms of weighting. So disproportionate impact. And, that's going to be the case going into 2025. What are we going to see with the Mag 7? Can they continue this stellar run? And as I wrote in my piece, it all just comes down to AI because all of these stocks are benefiting in some way from the boom in AI. if we see any bumps in the road there, they might pull back. On the other hand, if we see an acceleration in AI, maybe that benefits the group. I don't know. What are your thoughts on Mag 7? You think this is going to continue to be a theme in 2025, or at some point is it going to slow down?
I think anything AI is going to continue to be a theme for a while. This stuff is moving so fast. It's so scary to me. From an investment perspective, it looks like, I don't want to say it looks bubblish like 2001, but valuations are getting rich. But this is I know we're just at the edge of the beginning of this AI stuff, and it moved so fast. It's scary that few stocks are dominating and carrying everything, but they are.
Yeah.
I'm going to take the opposite. I think it's topped. I think it's starting to drain a little bit of the enthusiasm because it seems like it might be diffusing a bit. Amazon has an AI chip. I mean, it looks like the concentration is kind of, again, like diffusing.
Oh, I agree with that. I think that
Got
the concentration is going to continue to be dominated because it's going to
Yeah.
be everywhere. Everybody's going
I
to
guess,
have some AI version of something.
yeah, maybe it's going to be harder to play as it kind of just becomes ordinary or routine.
Right.
Yeah,
Right.
yeah. I mean, obviously, when you're talking about the amount of money that's up for grabs, there's going to be a ton of competition. Recently, people have been talking about Amazon getting into the AI chip game and how that's going to impact NVIDIA. Obviously, they have an 80-90% market share right now in the AI chip market. Can they maintain that? Because everyone's kind of gunning for them, NVIDIA, Amazon, AMD, you name it. So I think, yeah, there's going to be a lot to watch in this space over the next year, next 2 years. But I think you're right, Jeff. As long as AI continues to be, this huge theme, I think that's going to be a tailwind for the group. But if there's any hiccups in the AI story, and at some point, even if you believe AI is going to be massive in the future, there's going to be, ups and downs, some deceleration in growth rates that can impact them. Maybe not next year, maybe the year after. We'll keep an eye on that.
All right. Well,
Jeff, you wrote a story that was interesting to me earlier this week. It's about reshoring ETFs in the Trump trade. Can you talk a little bit about that?
yeah, it's actually a perfect segue from Mag 7 because this ETF, which is new, it was launched in May of 2023, and it's only got a little over $150 million in it. But its performance is since inception at around 62% since inception. That compares to 40% for the S&P 500. And this ETF, I'll get into the particulars of it as I go along here, but just because we were just talking about the Mag 7, this ETF owns no Mag 7. It doesn't directly own anything in the technology sector. So it's not riding that wave. That's a pretty impressive return for something that is not riding anything in as you explained, how much weight the Mag 7 is carrying in the market right now. This is a fund. It's called the TEMA American Reshoring ETF. Ticker is RSHO. It's managed by TEMA ETFs. It's a relatively new and small operation out of New York. They've got 7 ETFs, and this particular ETF, it's all about the reshoring and the onshoring effort. Now, remember, they launched in May of 2023 before anybody knew that Donald Trump was going to be the next president, with all of his talk of tariffs and American made. And the Trump election just was like a boost for that strategy, and probably other strategies that focus on the same thing. But what I think is unique about this ETF is it doesn't just lean on the infrastructure. That seems to be the kind of the bread and butter of anybody talking about reshoring and onshoring. This looks at materials, industrials, and infrastructure. And that's kind of where it's gotten most of its boost. Also, it's small and mid cap for the most part, not by design, but that's where they're seeing the most opportunities. And it's concentrated. There's less than 45 stocks in this portfolio, and that's how it's designed to be. I think it's a pretty interesting strategy. I mean, it's a clear bet on the reshoring trend that it probably has some legs. especially if tariffs kick in the way they're supposed to and all that other stuff. So
Yeah,
yeah,
yeah.
that's just a
This certainly seems like a trend that's secular, Jeff. I don't think
mhm.
necessarily it's even partisan. I think even the Biden administration was trying to get things built here in the U.S. with their
Right.
Infrastructure Act, their CHIPS Act, and things like that. And yeah, I mean, I don't see this going away, especially after we saw, what happened in COVID. We're reliant on China for a lot of manufactured goods. I don't think anyone wants to see a repeat of that. And I think the geopolitical tensions, especially with China, are just going to continue to ratchet up, or at least that's the consensus. Maybe something happens and that changes, but the consensus is tensions are going to rise with China. They might do something with Taiwan and create a geopolitical storm there. And in that case, we definitely don't want to be dependent on China for key manufactured goods. So near shoring, friend shoring, whatever you want to call it,
Hmm.
is something that I think a lot of people are going to be focused on.
Yeah, that's a good point about that this is not a this crosses over political, I guess, boundaries or whatever. Some of the things that Biden introduced during his presidency, actually, I was talking to the manager of this fund. He said that some of the things that Biden introduced during his presidency actually benefited red states more than blue states. Not that a president should put together plans and policies for particular states or political parties, but that just shows you how this infrastructure, I'm sorry, this onshoring and reshoring stuff is like you said, it's kind of a national issue and it's going to affect uh, U.S. companies in a big way, in a positive way, I think.
Yeah, yeah. And anytime an ETF can outperform the market like that without any of the Mag 7, that's pretty
Oh my
impressive.
God. Yeah, crazy,
Yeah.
crazy.
Well, speaking of, international, the theme, international theme, I wrote a story earlier this week about the best performing international ETFs. And the list kind of surprised me. No one's really been paying attention to international ETFs, to be honest. The US has just been dominating, but we have been seeing some movements there. There's been some strong performers. And actually, China, we just talked about China, has been the best performing international ETF group. If you look at yin, I know we've talked about this before. It's the direction 3x FTSE China Bull shares, YNN. It's up something like 70% in the year to date period through early December. So really strong gains. And even if you take out leveraged ETFs, you see that the iShares China Large Cap ETF, FXI, is up something like 39%. So we talked about why China ETFs have done well this year, and all the gains have really come since September. That's when the Chinese government came out and said they're going to unleash a bunch of monetary and fiscal stimulus. There hasn't been a lot of details with regard to that, but just the promise of that was enough to send shares of Chinese ETFs through the roof. They
Mm-hmm.
went up essentially in a straight line since then in over a 2 week period. And since then, they've been kind of up and down, but they're holding on to the gains. And I think a lot of people are optimistic that, they've put in a bottom. Chinese stocks and ETFs have just been horrible performers over the past 5, 10 years. But we've also seen like periods where they go up, briefly, and then they come right back down. I don't know if this is different. This is the start of a sustainable bull run in Chinese stocks. I think it's way too early to say that it is. We haven't really seen, a change in the trajectory of the Chinese economy yet. There's still a lot of concerns about demographics, about the property market bust that's going on there. So we'll see. I mean, 2025 is going to tell us a lot about whether this is sustainable. Two other ETFs I want to talk about. There was a short Brazil ETF. That was the second best performing international ETF.
Short Brazil. All right.
Yeah, short Brazil is the ProShares Ultra Short MSCI Brazil Capped ETF BZQ, up 72%. Haven't been following Brazil all that closely, but from what I read, it has to do with the rising deficits in that country, and that's pushing inflation higher and interest rates higher, which is actually the opposite of what we're seeing in Argentina. The Global X MSCI Argentina ETF ARGT is one of the best performing international ETFs this year with a 64% return. And that's because the new president, Milei, he's apparently done well in terms of bringing down inflation and bringing down interest rates, and that's helping the economy to accelerate there. So, quite a contrast between the two South American nations. Argentina doing well this year, while Brazil is doing poorly.
All right, good stuff. Good international wrap on that.
So, Jeff, before we introduce Paul, we've run through a lot of topics, but I definitely want to touch on this one, which is the first mutual fund company, the first company to ever launch a mutual fund apparently has launched an ETF. I know you wrote a story on this, super interesting stuff. Can you tell us about it?
Yeah, MFS, a Boston-based MFS Investment Management based in Boston. 100 years ago, 1924, they launched the first U.S. mutual fund, open-end mutual fund, and earlier this month they launched they got into the ETF space. Better late than never, I guess. They launched 5 ETFs, all active value, active growth, active international, active core plus bond, and active intermediate muni bond, showing kind of their breadth and depth there at MFS. It's a $700 billion mutual fund shop, now an ETF shop as well. I had a conversation with the folks over there. They said that they spent more than a year putting this thing together. It's where they see growth and opportunity, but like a lot of these old legacy mutual fund companies, they say that they're sticking to their knitting. They're not abandoning mutual funds, even though they're experiencing the same kind of outflows that the broader mutual fund industry is. Obviously, they have a toehold in the 401k plan space, which is where pretty much where mutual funds are hanging on for dear life. There's no reason to believe that they won't do well here. I don't think they're going to be rolling these things out every 6 months or anything like that, but they are looking for areas of opportunity, and we'll see if that MFS brand name carries them forward, how well they do. I know they got a loyal following.
Yeah, they have I think over $600 billion in assets under management. So this is definitely not a small firm. And this is a milestone. I think the first mutual fund company launching an ETF. That just tells you, how, the tide has kind of shifted against mutual funds and is lifted ETFs. I wonder why they did it, in 2024. Do you have any idea, Jeff? Obviously, they could have done it last year. They could have done it next year. Why now?
Well, I don't know, because they didn't celebrate that too much in their promotion, like 100 years after. Because you don't, if you if you're a mutual fund company and you haven't gotten into the ETF space yet, you're not going to say, hey, we launched a mutual fund 100 years ago, and I'm assuming that they didn't really want that peg, because it makes them look really late to the game. But they looked at remember when there was the semi-transparent ETFs, they looked at that. They never got into it. They didn't feel like it was the right vehicle for them. Remember, ETFs, active mutual fund managers, when the idea of active ETFs or semi-transparent ETFs came around, there was all this fear of front running and stuff like that, because ETFs trade daily. If they're going to go, show everybody what's in the portfolio, they're like, oh man, that's our competitive advantage. But it was, I don't know. I don't think they timed it to this year. I think they probably would have preferred it wasn't on the 100-year anniversary of their shop, just based on the way they didn't kind of lead with that in their press releases and stuff like that. But I was trying to think, and to me, I don't know if you would know this. I'm not trying to, trip anyone up here, but I wonder what major mutual fund companies are still sitting on the sidelines when it comes
That's
to
exactly
ETFs.
what I was going to ask you, Jeff. I don't know that off the top of my head, but that is a great question.
I don't know either. I mean, we've seen the waves of them coming in, and there were like first wave, second wave, and now we're looking at some of the stragglers.
Yeah.
Some of the ones that have gotten into it have done really, really well. Well, most of them
Yeah.
that have gotten into it have done really well, considering when you contrast that to the outflows in the mutual fund space. But anyway, I guess we'll wait for the next shoe to drop because we know there's not going to be an older mutual fund company to come in, but there might be a mutual fund company that is a boutique or something that we haven't thought of yet that is still waiting for the right opportunity to launch an ETF.
Right.
But
I
anyway,
did see something about SEI. Are you familiar with SEI?
yeah.
I think I saw a headline that SEI is filing to create ETFs out of their mutual funds. So
No,
that's another.
what they filed for was ETF share classes.
Okay.
Yeah, that's actually another topic for another time. And
Okay.
actually
Maybe
on our sister podcast, Advisor Insider,
okay.
folks can look that up, and there's a whole conversation here about ETF share classes. But the SEI thing is news. That is brand new this week that they filed for a multi-share or a multi-asset ETF share classes. Those things are just sitting there on somebody's desk at the SEC, and who knows when they'll ever get approved. All right, we're wrapping up here this week with an introduction of a brand new boss here at ETF.com, Paul Curcio. Paul is our new managing editor. He's already on board, already bossing people around like he's supposed to. I've known Paul for about 5 years. I worked with him at Investment News, where we both used to work. I've said this to people on the staff, and I don't have a problem saying it here. I think Paul's a really good guy. He's got a good news sense. He's a good manager of people, and he seems like a fair guy. And well, he's always been fair to me, at least. So I know I'm not always easy to be fair with. So I want to introduce you to Paul. Paul, how you doing? Thanks for being here.
Thanks, Jeff, for the marvelous introduction. Oh, by the way, I'll be Venmoing you that little payment right after the podcast is over. Thanks for the endorsement. Yeah, it's great to be here. It's really exciting to join ETF.com. I've been a user of the site for a long time. I've cited it in many of the stories that I've used over the years that ever focus on ETFs. And it's a great resource. So I'm happy to be a great part of it. And you guys are really knowledgeable of the industry. And it was great to sit here like a fly on the wall and listen to you talk about it. And it occurred to me that last conversation you had about which mutual fund companies still haven't joined the party. I smell a feature, guys. So let's talk about that another time. After the podcast.
All right. Yeah, good point. We need to figure out what that is. We probably should have done it research Smeet before we started talking, but I mean, whatever. That's what we do here. We just talk and figure things out.
Shooting the breeze, buddy. Shoot the breeze and see what comes out. It's always really a good way to ideate and find new
just
stories.
To let our audience know, the idea for this reformatted Exchange Traded Fridays really came out of our news meetings. Many of these are the same kind of conversations we have every morning, trying to figure out what's new and what's worth writing about and discussing and stuff. And so we figured this would be more interesting than just talking about general things or trends
or the Detroit Lions.
Well, that's for another podcast. Okay, come on.
Okay.
All right, folks. Well, we're gonna wrap it up there. Want to let you know that now that you know Paul, you can expect him, down the road, probably joining these podcasts and chiming in and sharing his insights, along with everyone else on the ETF.com staff. In this episode, I want to thank Sumit Roy, Ron Day, and of course Paul Curcio. I'm Jeff Benjamin, and this is Exchange Traded Fridays. We drop every Friday. We're always looking for your feedback and insights, and you can reach out to us at ETF.com. Look for everything we've got going on there. So thank you very much, folks. Have a great Friday.